Good day, everyone. Garrett Moore here, More Financial Management. The past 2 months have been a stark reminder to many of us about the inherent risk involved with traditional types of investing. As a result, we've received a lot of questions from clients about whether or not we should be doing anything different with our portfolios, and more specifically, if there's any way we can bring about a greater degree of predictability to them. The answer is yes, so that's what I wanted to share with everybody today. So we're going to be talking about how to market-proof your future. Of course, do not act on any of this advice without conferring with a professional that's intimately aware with your needs. We're going to be talking about annuities as the more predictable option. We're going to be talking about who should and shouldn't consider them, how to use them for growth, how to use them for income, and what to look out for when it comes to specific types of annuities. I want to make one thing abundantly clear before we move on, and that is that we are talking about annuities today as a complement to a more traditional portfolio of stocks, bonds, and mutual funds. Very rarely should an annuity be considered as a complete replacement, okay? So with that being said, we are going to talk about what I consider to be the foundation. And that is a globally diversified portfolio of stocks, bonds, mutual funds, exchange-traded funds that has been tailored to your needs. This is like what we're currently doing at TD Ameritrade. In this sense, we will compare and contrast the foundation, to what we're calling the complement, which is an annuity. So with that said, like I said, the foundation is a diversified mix of stocks, bonds, and mutual funds that has been tailored to your preferences. These types of investments are offered through investment companies themselves, like Vanguard or BlackRock. The reason I consider this to be the foundation of financial planning and portfolio management is because it likely has the greatest efficiency as far as risk and reward. This is where you're probably going to get the greatest bang for your buck over time, in other words. Over time, especially longer periods of time, these have good probabilities of success. However, in the short term, there are no guarantees. So that's why we want to talk to our clients about annuities, to let them know that they do have other options. Like I said, annuities as the complement. The biggest difference here is that an annuity is offered through an insurance company as opposed to an investment company, such as Nationwide or TIAA. Because of that drastic difference, these insurance companies are legally allowed to, and most importantly, financially able to, offer you some form of a guarantee if you are an investor in an annuity. So let's talk about what kind of guarantees there are. Well, there are guarantees against losses. There are guarantees for growth of your future income potential, and there are guarantees for income for as long as you live. We'll go into those in more detail. First, let's address the elephant in the room. And annuities are like just about anything else. They have gotten significantly better over time. Annuities of yesteryear had a lot of shortcomings that led people to have a poor perception of them that was frankly warranted a lot of the time. Fortunately, these newer types of annuities have addressed a lot of those shortcomings. So let's look at them specifically. Annuities of yesteryear would have excessively long surrender periods. That meant that if you attempted to withdraw your money within that surrender period, the annuity company would penalize you heavily for it. Sometimes the surrender periods were up to 12 years long. That was a very tough pill to swallow. Fortunately, annuities that are more current have much more palatable surrender periods. 5 years is a common one. In other words, you need to be comfortable investing in one of these annuities for a period of 5 years. Annuities of yesteryear also had a reputation for paying huge commissions to the advisors, as well as high fees that went to the annuity company. Annuities of today can be had entirely commission free, and they will also have some of the lowest fees available. Another common misperception is that the annuity company is going to keep whatever is left in the annuity after you have passed away. That's actually not true. If you purchase the correct type of annuity and set it up properly, the remainder can go to the beneficiary of your choosing. So let's talk about who these are generally appropriate for. These are still long-term savings vehicles. Due to IRS law, you need to be 59 and a half years of age or older before you take a cash distribution from one of these annuities. Conversely, these are generally not appropriate for young investors and for very aggressive investors. Let's touch on how to use an annuity for growth. Okay, if we're talking about growth, the ideal investor here is going to be a saver, somebody that's still in the accumulation period of their lives, or conservative investors. And the potential solution here is what is known as a fixed indexed annuity. So let's talk about its key attributes. There is actually a contractual zero potential for loss. You are, on the flip side, entitled to stock market-like growth potential, okay, subject to a limit. And that subject to a limit is the key there that we need to be very aware of, and we'll touch on that in just a second. Another neat benefit is that each year represents a high watermark. So if you receive gains in any given year, that is your new floor, okay? That is where that zero potential for loss steps up to. So this is what that looks like visually. This is a fixed indexed annuity from the company by the name of Great American. This particular annuity has a 6% cap. So in any given year, you cannot earn more than 6%. So the blue line in this instance, that represents the S&P 500. That's a broad measure of the U.S. stock market. This chart begins right at the peak of the technology crash of 1999. So you can see that in years where the S&P 500 declined, the blue line, the fixed indexed annuity did not. Okay, that's where that contractual guarantee against losses comes in. Conversely, any year in which there was a gain, the fixed indexed annuity would have been credited with up to 6% growth. So their summary there in the green box kind of sums it up. By locking in gains and avoiding losses related to market drops, the fixed indexed annuity provided steadier returns. Let's talk about some gotchas that are involved with fixed indexed annuities. Like I mentioned before, you need to be very clear on what the limit is on your growth potential and how they are limiting it. There's a couple of different ways they can do it. You also need to be very clear on what the length of the surrender period is. The safest way to go about this is that you simply want to be entirely comfortable leaving whatever amount that you invest in one of these for the entire length of the surrender period. Let's move on to how you can use an annuity for income. Okay, the ideal investor here is those that are right on the precipice of retirement and those that are already retired. And the potential solution is what is known as a variable annuity with living benefits. So what is that exactly? These can be utilized with a two-step process, and the first is optional. So if you can wait to receive income from one of these, the annuity company will actually guarantee the growth of your future income potential. The 7% for 10 years is what is currently offered through Nationwide. So step 2 is after you have deferred your income for any amount of time, you are then ready to start receiving that monthly income. You kind of flip that income switch. The beauty of receiving income from an annuity is that, first and foremost, it's going to continue for as long as you live. It doesn't matter if you make it until you're 110 years old. The annuity company is going to continue paying you. An especially cool feature of this is that they will pay you more than you paid them. Okay, so this protects against longevity risk. And that's sort of the idea that it's far more challenging to plan for a 30-year retirement than it is to plan for a 20-year retirement, for example. Once you lock in that income, once you begin receiving that monthly income, that amount can never go down, regardless of what the stock market does. Even if it declines, your monthly income can never go down. That's a pretty powerful tool. So what are the gotchas involved with a variable annuity with living benefits? First and foremost, you need to be abundantly clear that you can't take a lump sum of your income potential. So going back to this slide where we talk about that 7% figure for 10 years, if you're thinking, great, I'm going to take this deal, and at the end of the 10 years, I'm just going to withdraw that lump sum and go do something else with it. No, that is not how this works. You cannot do that. If you want to take advantage of that benefit, you must leave the money in the annuity and actually use it to receive monthly distributions from it. You also need to shop around for the best rates. Okay, we talked about that growth of your income potential rate, that 7% that's currently offered through Nationwide. That's going to vary insurance company to insurance company. And also the amount that they're going to pay you when you are ready to receive your income, that is also going to vary from insurance company to insurance company. So you need to look around and make sure that you're getting one of the better rates out there while also being cognizant of other aspects of the annuity. You also want to consider the financial rating of this annuity company. So yes, these are contractually guaranteed by the annuity company, but you still want to be absolutely certain that they have a sound financial rating so that they are able to pay you that guaranteed payment. So this is a chart of hypothetical retirement income sources. Okay, I'll draw your attention to the very bottom. Again, I want to reiterate that these are ideally used as complements to traditional portfolios of investments, not as replacements. So on the right side, we're going to have your Social Security. You might consider incorporating an annuity. And then you are, of course, going to have your more standard investments, stocks, bonds, mutual funds, things of that sort. So this is an important planning strategy that I think everybody should consider. And that is splitting sort of your future financial desires between wants and needs. Okay, so when I say needs, I'm talking things about housing, groceries, utilities, medical care, things that you really can't go without. On the flip side, your wants are going to be things like that lake house, or lavish travel, or a boat, or whatever it may be in your situation. So once that's done, you might consider coupling an annuity with your Social Security in a fashion that between the two, they cover your needs more or less. Then your higher growth potential investments are more earmarked for your wants. So in this sense, the guaranteed monthly payment from an annuity and a Social Security payment create a psychological floor, so that at least you know that those two have your basic standard of living covered. Sort of brings some peace of mind knowing that those expenses are covered and not exposed to market fluctuations. So how to go about deciding if one of these would be worth your consideration? Simply ask yourself, would I feel better with having some of my portfolio protected, being less exposed to market fluctuations, or having guaranteed income that I cannot outlive regardless of what the market does? If you can answer yes to any of those, then let's simply talk. We have partnered with over 10 different insurance companies, each that offer a multitude of annuities under it. At that point, I would be able to help you determine whether or not this is going to be appropriate for you. Sometimes it is, sometimes it isn't. And then more specifically, what does an optimal solution look like in your scenario? Hope that was helpful. As always, you can call me, you can text me, you can email me. Let me know what questions you have. I appreciate your time and appreciate y'all. Have a wonderful day. Bye-bye.